Question 1. Understanding long-term care services. What is the primary distinction between institutional care and home and community-based services in the context of long-term care insurance? A. Institutional care provides more intensive medical supervision compared to home and community-based services. B. Home and community-based services typically have no eligibility requirements, while institutional care does. C. Institutional care is generally more affordable than home and community-based services. D. Home and community-based services are exclusively provided by healthcare professionals, whereas institutional care can include non-medical support. Answer A. Institutional care provides more intensive medical supervision compared to home and community-based services. Explanation. Institutional care, such as nursing homes, provides 24/7 medical supervision and assistance, catering to individuals with severe health conditions or disabilities who cannot live independently. In contrast, home and community-based services offer assistance in the individual's home or community setting, focusing on non-medical support and allowing for greater autonomy. This distinction is crucial for understanding the options available in long-term care insurance policies and helps determine the appropriate level of care for clients based on their health status and personal preferences. Question 2. Scenario-based question. Mr. Thompson is a 72-year-old retiree who has recently been diagnosed with early-stage Alzheimer's disease. He is considering purchasing a long-term care insurance policy to help cover potential future needs. During a consultation with his insurance agent, he learns about the elimination period in LTC policies. Which of the following should Mr. Thompson prioritize when evaluating the implications of the elimination period on his long-term care insurance policy? A. The length of the elimination period and how it affects his immediate access to benefits after the policy is activated. B. The elimination period's impact on premium costs and whether it increases or decreases over time. C. The relationship between the elimination period and the types of services covered under the policy. D. The possibility of waiving the elimination period in case of a severe medical condition. Answer A. The length of the elimination period and how it affects his immediate access to benefits after the policy is activated. Explanation. The elimination period in a long-term care insurance policy refers to the duration of time the policyholder must wait after qualifying for benefits before receiving them. This period could significantly affect Mr. Thompson's access to funds for care, especially given his recent diagnosis. A longer elimination period may mean higher initial out-of-pocket costs before the insurance kicks in. Understanding this concept is vital for making informed decisions about coverage and financial planning for future care needs. Other options may not accurately address the fundamental nature of the elimination period and its direct effect on accessing benefits. Question 3. Regulations governing LTC insurance. Which of the following statements accurately reflects the requirements set forth in the Oklahoma Long-Term Care Insurance Consumer Protection Act regarding disclosure to policyholders? A. Insurers are required to disclose all potential rate increases that may occur after the policy is issued. B. Insurers must provide a summary of the benefits and coverage options before the sale of the policy, but they are not required to disclose exclusions. C. Insurers must inform policyholders about the availability of inflation protection options during the sales process. D. Insurers are allowed to change policy provisions without notifying the policyholder as long as they maintain the same premium rates. Answer. C. Insurers must inform policyholders about the availability of inflation protection options during the sales process. Explanation. The Oklahoma Long-Term Care Insurance Consumer Protection Act mandates that insurers must provide clear information regarding the benefits, coverage options, and the availability of inflation protection options during the sales process. This ensures that policyholders are fully informed about the features that can help protect their benefits from inflationary pressures over time. Option is incorrect because while insurers may disclose potential rate increases, it is not a universal requirement for all policies. Option B is misleading. While a summary of benefits is required, insurers must also disclose key exclusions. Option D is false. Policy provisions cannot be changed without the policyholder's notification, as it affects the terms of coverage and the insured's rights. Question 4. Key policy provisions. Which of the following provisions in a long-term care insurance policy is primarily designed to protect the policyholder's benefits from being eroded by inflation? A. Benefit amounts and duration. B. Inflation protection options. C. Elimination period. D. Non-forfeiture benefits. Answer. B. Inflation protection options. Explanation. Inflation protection options in a long-term care insurance policy are specifically designed to help maintain the purchasing power of the policyholder's benefits over time. As healthcare costs rise, these options can adjust the benefit amounts to keep pace with inflation, ensuring that policyholders can afford necessary care when they need it. Option addresses the benefit limits but does not provide specific inflation safeguards. Option C, the elimination period affects when benefits begin but does not relate to inflation. Option D refers to non-forfeiture benefits, which protect against loss of coverage but do not address inflation directly. Question 5. Underwriting and risk assessment. In the underwriting process for long-term care insurance, which of the following factors is generally considered the most significant in assessing an applicant's risk? A. The applicant's income level. B. The applicant's age and health status. C. The applicant's family history of chronic illness. D. The applicant's prior insurance claims history. Answer. B. The applicant's age and health status. Explanation. The most critical factors in the underwriting process for long-term care insurance are the applicant's age and health status. Insurers closely examine these elements to determine the likelihood of needing long-term care and the associated costs. Older applicants and those with pre-existing health conditions typically present higher risks, leading to higher premiums or possible denial of coverage. While income level, option A, may influence a person's ability to pay premiums, it is not a direct risk factor. Family history, option C, can be relevant but is secondary to individual health. Option D, prior claims history, is more pertinent in property or casualty insurance rather than LTC insurance underwriting. Question 6. Claims process. What is the primary reason for the denial of long-term care insurance claims? A. The insured has not met the policy's benefit triggers. B. The insured has exceeded the maximum coverage limit. C. The insured has not paid premiums for over 6 months. D. The insured failed to submit the claim within the required time frame. Answer A. The insured has not met the policy's benefit triggers. Explanation. Claims are often denied because the insured has not met the specific benefit triggers outlined in the policy. Benefit triggers typically include activities of daily living, adults, such as bathing, dressing, or eating, which must be compromised to qualify for benefits. If the insured does not demonstrate a sufficient level of impairment, the claim will be denied. While exceeding coverage limits, option B, can also result in claim issues, it is less common than failure to meet triggers. Option C regarding unpaid premiums can lead to policy cancellation but not necessarily to claim denial if the policy was active at the time of the claim. Option D is important but is typically not the primary reason for denial. Insurers usually allow a reasonable time frame for submitting claims. Question 7. Financing long-term care. Which of the following statements about financing long-term care is correct? A. Medicare fully covers the costs of all long-term care services for eligible individuals. B. Medicaid can assist with long-term care costs for low-income individuals, but only after they have depleted most of their assets. C. Private pay is the most common method of financing long-term care in the United States. D. Long-term care insurance policies typically do not cover any home and community-based services. Answer. B. Medicaid can assist with long-term care costs for low-income individuals, but only after they have depleted most of their assets. Explanation. Medicaid provides coverage for long-term care services for eligible low-income individuals, but it typically requires applicants to exhaust their personal assets to qualify for benefits. This aspect of Medicaid is crucial in the planning process for individuals who may require long-term care. Option is incorrect because Medicare does not cover long-term care costs comprehensively. It has limited coverage for skilled nursing care under specific conditions. Option C is misleading as private pay is often not the most common financing method and many rely on Medicaid or Medicare for support. Option D is false. Many long-term care insurance policies do cover home and community-based services, although coverage specifics vary by policy. Question 8. Marketing and sales practices. When marketing long-term care insurance, what is one critical ethical consideration agents must adhere to? A. Agents must always offer the cheapest policy available to ensure affordability for clients. B. Agents should prioritize the sale of policies that provide the highest commission for themselves. C. Agents must conduct a thorough needs assessment to determine the most suitable policy for the client. D. Agents should avoid discussing any potential exclusions in the policy to prevent discouraging clients from purchasing. Answer. C. Agents must conduct a thorough needs assessment to determine the most suitable policy for the client. Explanation: conducting a thorough needs assessment is an ethical obligation for agents selling long-term care insurance. This process involves understanding the client's health status, financial situation, and care needs to recommend the most appropriate policy. It ensures that clients are making informed decisions based on their individual circumstances rather than the agent's financial incentives. Option is misleading. While affordability is important, the cheapest policy may not meet the client's needs. Option B prioritizes the agent's commission over the client's best interest, which is unethical. Option D is unethical as well. Transparency about potential exclusions is critical for informed decision-making. Question 9. Current trends and future of long-term care. Which of the following trends is currently impacting the landscape of long-term care insurance? A. Decreasing demand for home care services due to the aging population preferring institutional care. B. Increased availability of technology-driven solutions for monitoring and providing care. C. A rise in policies that offer fewer coverage options to lower premiums. D. A shift toward universal long-term care insurance policies offered by the government. Answer: B. Increased availability of technology-driven solutions for monitoring and providing care. Explanation: the long-term care sector is experiencing significant growth in technology-driven solutions that improve the monitoring and delivery of care. These advancements include telehealth services, remote monitoring devices, and apps that assist with medication management, allowing individuals to receive care more effectively at home. Option is incorrect, as many individuals prefer home care services to institutional care. Option C does not reflect a trend, as the market is moving towards offering more comprehensive options, not fewer. Option D is misleading. While there are discussions about universal coverage, it has not yet been implemented widely. Question 10. Consumer protections. Under the Oklahoma Long-Term Care Insurance Consumer Protection Act, which of the following practices is strictly prohibited? A. Providing policyholders with information about potential rate increases. B. Selling policies that contain misleading or ambiguous terms regarding coverage. C. Offering discounts to policyholders for early payment of premiums. D. Informing clients about the benefits of inflation protection options. Answer: B. Selling policies that contain misleading or ambiguous terms regarding coverage. Explanation: the Oklahoma Long-Term Care Insurance Consumer Protection Act is designed to protect consumers from unfair and deceptive practices in the sale of long-term care insurance. Selling policies with misleading or ambiguous terms undermines this goal and can lead to significant financial harm for consumers. Option is incorrect, because insurers are generally required to disclose potential rate increases. Option C is permissible as long as it complies with state regulations, and option D is encouraged as part of the sales process to ensure clients are informed about their options. Question 11. Types of long-term care insurance policies. Which of the following types of long-term care insurance policies typically offers the most flexibility and benefit options? A. Group policies. B. Individual policies. C. Hybrid policies. D. Limited benefit policies. Answer: C. Hybrid policies. Explanation: hybrid policies, which combine life insurance with long-term care benefits, typically offer the most flexibility in terms of benefit options. These policies allow policyholders to access funds for long-term care if needed, and if not used, the remaining death benefit can be passed on to beneficiaries. Group policies, option A, often have standardized benefits with less flexibility, while individual policies, option B, can vary but may not provide the unique advantages of a hybrid model. Limited benefit policies, option D, generally restrict the amount and duration of coverage, making them less flexible. Question 12. Financing long-term care. Which of the following statements best describes the relationship between Medicare and long-term care services? A. Medicare provides unlimited coverage for all long-term care services after hospitalization. B. Medicare only covers short-term, skilled nursing facility stays under specific conditions. C. Medicare fully covers home health care services for any duration as long as a physician recommends them. D. Medicare does not cover any long-term care services, including nursing home care. Answer: B. Medicare only covers short-term, skilled nursing facility stays under specific conditions. Explanation: Medicare provides limited coverage for skilled nursing facility (SNF) care, but only if the patient has been hospitalized for at least 3 days and is admitted to the SNF within a specific time frame for recovery. This coverage is typically short-term and does not apply to long-term care needs, which are usually addressed by Medicaid or long-term care insurance. Option A is incorrect as there are limits to coverage duration. Option C is misleading. While Medicare covers some home health services, it does not do so indefinitely. Option D is also incorrect. Medicare does cover limited long-term care services, but under strict guidelines. Question 13. Claims process. What documentation is generally required to successfully file a long-term care insurance claim? A. Proof of income and tax returns from the previous year. B. A physician's statement confirming the need for long-term care services. C. A list of all medications the insured is currently taking. D. The insured's medical history from the past 5 years. Answer. B. A physician's statement confirming the need for long-term care services. Explanation. When filing a long-term care insurance claim, one of the primary documents required is a physician's statement that confirms the insured's need for long-term care services. This statement helps demonstrate that the insured meets the policy's benefit triggers. Option A regarding income and tax returns is not typically relevant for claims. Option C, while useful for understanding treatment, is not a primary requirement. Option D may be requested for underwriting purposes but is not necessary for filing a claim. Question 14. Ethical considerations in sales. Which of the following best describes an ethical consideration for agents selling long-term care insurance? A. Agents should prioritize selling policies with the highest profit margins. B. Agents must recommend policies based solely on the cheapest premiums. C. Agents should provide clients with a full disclosure of policy features and limitations. D. Agents can omit certain policy details if they believe it will make the sale easier. Answer. C. Agents should provide clients with a full disclosure of policy features and limitations. Explanation. Ethical sales practices in long-term care insurance require agents to fully disclose all policy features, benefits, limitations, and exclusions. This transparency ensures that clients can make informed decisions about their coverage options. Option A focuses on the agent's profit rather than the client's needs, which is unethical. Option B may lead to inadequate coverage as cheaper premiums might not provide necessary benefits. Option D is unethical and can lead to significant misunderstandings and dissatisfaction on the part of the client. Question 15. Underwriting and risk assessment. Which risk factor is considered least impactful in the underwriting process for long-term care insurance? H. B. Lifestyle choices. E. G. Smoking, alcohol use. C. Geographic location. D. Credit history. Answer. D. Credit history. Explanation. In the underwriting process for long-term care insurance, age and lifestyle choices such as smoking or alcohol use are significant risk factors because they directly influence the likelihood of needing long-term care. Geographic location can also be relevant due to regional health trends. However, credit history, option D, is generally not a critical factor in assessing the risk for long-term care needs and does not affect the underwriting decision as directly as the other factors. Question 16. Policy provisions. What is the primary purpose of the renewability provisions ECA long-term care insurance policy? A. To guarantee the policyholder can keep their coverage regardless of changes in health. B. To allow the insurer to cancel the policy after a certain age. C. To set a specific duration for how long benefits will be paid. D. To determine the total amount of premiums paid over the life of the policy. Answer A. To guarantee the policyholder can keep their coverage regardless of changes in health. Explanation. Renewability provisions ensure that policyholders can maintain their long-term care insurance coverage even if their health deteriorates. This is a crucial aspect of the policy, as it protects the insured against losing coverage due to health changes that could occur over time. Option B is incorrect. Policies generally cannot be cancelled solely based on age. Option C relates to benefits duration but does not pertain to renewability. Option D refers to premiums, which is not the main focus of renewability provisions. Question 17. Current trends in long-term care. What emerging trend in long-term care insurance is primarily driven by advancements in technology? A. Decreased interest in traditional nursing home facilities. B. The rise of virtual assessments for policy underwriting. C. Increased availability of short-term care options. D. The development of more complex policy structures with numerous riders. Answer. B. The rise of virtual assessments for policy underwriting. Explanation. Advancements in technology have led to the implementation of virtual assessments for underwriting long-term care insurance policies. These assessments can streamline the process, making it more efficient and accessible for applicants. Option: there's an indirect trend but not primarily driven by technology. Option C is less about technology and more about changing service delivery preferences. Option D, while true in some cases, is not as directly linked to technological advancements as virtual assessments are. Question 18. Regulations impacting LTC insurance. What is one significant aspect of the Health Insurance Portability and Accountability Act (HIPAA) that impacts long-term care insurance? The HIPAA mandates that all long-term care policies must have a minimum coverage period. B. HIPAA ensures the privacy and security of the insured's health information during the underwriting process. C. HIPAA requires long-term care insurers to provide a summary of benefits to all policyholders. D. HIPAA limits the amount of premiums that can be charged for long-term care insurance. Answer: B. HIPAA ensures the privacy and security of the insured's health information during the underwriting process. Explanation: HIPAA establishes standards for protecting sensitive patient health information, ensuring that any medical information collected during the underwriting process for long-term care insurance is kept private and secure. This is critical for maintaining confidentiality and building trust with policyholders. Option is incorrect, as HIPAA does not set minimum coverage requirements for policies. Option C is misleading. While insurers must provide information, this is not a requirement of HIPAA. Option D is incorrect. HIPAA does not regulate premium pricing. Question 19. Claims process challenges. Which of the following is a common challenge faced by policyholders when filing a claim for long-term care insurance? A. Lack of awareness of the policy's benefits. B. Overwhelming documentation requirements that can delay the process. C. The insurance company automatically approving all claims. D. The inability to appeal a claim decision. Answer: B. Overwhelming documentation requirements that can delay the process. Explanation: one of the most significant challenges for policyholders when filing a claim is the extensive documentation required to support their claim, which can often delay the approval process. Insurers typically require a variety of documents, including medical records and proof of care, which can be burdensome to gather. Option A is also a challenge, but the complexity of documentation is more commonly reported. Option C is incorrect. Claims are not automatically approved if they undergo a review process. Option D is also incorrect. Policyholders do have the right to appeal claim decisions if they believe their claim was wrongly denied. Question 20. Long-term care insurance alternatives. Which of the following is considered a potential alternative to purchasing long-term care insurance? A. Savings and investment accounts specifically earmarked for long-term care expenses. B. Purchasing a life insurance policy with a long-term care rider. C. Relying on family members for care as needed. D. All of the above. Answer: D. All of the above. Explanation: each of these options can serve as an alternative to purchasing traditional long-term care insurance. Savings and investment accounts. Option A allow individuals to set aside funds for potential long-term care expenses. A life insurance policy with a long-term care rider. Option B provides a hybrid approach, enabling access to funds for long-term care while still having a death benefit, relying on family members. Option C is a common approach for many individuals, though it may not always be feasible or sustainable. Therefore, all options listed are valid alternatives. Question 21. Policy limitations. Which of the following is a common limitation found in long-term care insurance policies? A. Coverage for only specific types of facilities. B. Unlimited benefit periods. C. Guaranteed issue without health screenings. D. Automatic renewal regardless of age. Answer A. Coverage for only specific types of facilities. Explanation: long-term care insurance policies often specify the types of care facilities that are covered, which can limit the insured's options. For example, some policies may only cover care in licensed nursing homes or assisted living facilities, excluding home health care or informal caregivers. Option B is incorrect, as most policies have a defined benefit period. Option C is also incorrect. Many insurers require health screenings during the application process. Option D is misleading. While some policies have renewability provisions, they may not guarantee renewal regardless of age or health status. Question 22. Premium rates. What factor most commonly influences the premium rates for long-term care insurance? A. The applicant's credit score. B. The applicant's age at the time of application. C. The insurance company's investment performance. D. The applicant's income level. Answer B. The applicant's age at the time of application. Explanation: the age of the applicant is one of the most significant factors affecting long-term care insurance premiums. Generally, the younger the applicant is at the time of application, the lower the premiums will be, as younger individuals are typically viewed as lower risk for needing long-term care. Option A. Credit score does not directly influence rates. Option C. While related to the insurer's financial health, does not affect individual premiums. Option D is also not a primary consideration in premium determination. Question 23. Market trends. Which of the following trends is currently influencing the long-term care insurance market? A. Increased regulation leading to more uniform policies. B. A rise in demand for customized coverage options. C. A decrease in public awareness about long-term care needs. D. The elimination of hybrid policies from the market. Answer B. A rise in demand for customized coverage options. Explanation: consumers are increasingly seeking customized long-term care insurance solutions that better fit their specific needs and preferences. This trend reflects a growing awareness of the importance of long-term care planning. Option A is inaccurate, as regulations may vary widely and do not necessarily lead to uniformity. Option C is misleading. Awareness about long-term care needs has generally increased, not decreased. Option D is incorrect. The hybrid policies are gaining popularity, not being eliminated. Question 24. Policy riders. What is the purpose of an inflation protection rider in a long-term care insurance policy? A. To ensure that premiums do not increase over time. B. To increase the benefit amount as the cost of care rises. C. To provide coverage for additional services not included in the base policy. D. To allow policyholders to switch to a different insurer without penalty. Answer B. To increase the benefit amount as the cost of care rises. Explanation: an inflation protection rider is designed to adjust the benefit amount of a long-term care insurance policy over time to keep pace with inflation and rising costs of care. This ensures that policyholders have adequate coverage when they need it. Option is incorrect. Inflation protection does not guarantee stable premiums. Option C does not describe the primary purpose of this rider, and option D is unrelated to inflation protection. Question 25. Consumer awareness. Which of the following actions can best help consumers understand their long-term care insurance options? A. Consulting only with friends and family for advice. B. Attending educational seminars and workshops. C. Relying solely on advertisements from insurance companies. D. Ignoring policy details and focusing on premium costs. Answer B. Attending educational seminars and workshops. Explanation: educational seminars and workshops provide consumers with valuable information about long-term care insurance, including coverage options, policy features, and the importance of planning for long-term care needs. This proactive approach helps individuals make informed decisions. Option A may lead to misinformation, while option C can be biased. Option D can result in inadequate coverage, as premium costs alone do not reflect the value of the policy. Question 26. Benefit triggers. What is a common benefit trigger for long-term care insurance policies? A. The need for home modifications. B. The inability to perform at least 2 activities of daily living adults. C. A diagnosis of a terminal illness. D. The presence of chronic pain. Answer B. The inability to perform at least 2 activities of daily living adults. Explanation: most long-term care insurance policies define benefit triggers based on the inability to perform a specified number of adults, such as bathing, dressing, eating, toileting, transferring, and continence. This criterion is commonly used to assess eligibility for benefits. Option A does not typically serve as a trigger, while option C is often relevant to life insurance rather than long-term care. Option D, although it can affect the need for care, is not a formal trigger. Question 27. Long-term care settings. Which of the following settings is typically covered by long-term care insurance? A. Unlicensed residential care homes. B. Family members providing informal care. C. Assisted living facilities. D. Adult daycare centers with no licensing. Answer C. Assisted living facilities. Explanation: long-term care insurance policies often cover care received in licensed assisted living facilities, which provide a level of care that meets the policy's requirements. Unlicensed residential care homes, option A, and informal family care, option B, are usually not covered. Adult day care centers, option D, may be covered, but only if they meet certain licensing requirements. Question 28. Exclusions in policies. Which of the following is a common exclusion found in long-term care insurance policies? A. Care received outside the United States. B. Care for Alzheimer's disease. C. Respite care services. D. Care for injuries resulting from a fall. Answer A. Care received outside the United States. Explanation. Many long-term care insurance policies exclude coverage for care received outside the US. This can be a significant limitation for travelers or expatriates. Options B and D typically are not excluded, as most policies cover various conditions, including Alzheimer's and injuries from falls. Respite care services, option C, may also be included depending on the specific policy. Question 29. Tax benefits. What is one potential tax benefit associated with long-term care insurance premiums? A. Premiums can be deducted as business expenses for self-employed individuals. B. Premiums are tax-free under all circumstances. C. Premiums can be deducted as medical expenses for itemized deductions subject to limits. D. Premiums are considered a taxable income for the insured. Answer C. Premiums can be deducted as medical expenses for itemized deductions subject to limits. Explanation. In the United States, long-term care insurance premiums may be deductible as medical expenses if the taxpayer itemizes deductions, but only up to certain limits based on the insured's age. Option A may apply in specific contexts, but not universally. Option B is incorrect, as there are circumstances where premiums may not be deductible. Option D is also incorrect. Premiums are not considered taxable income. Question 30. Market trends in consumer behavior. What trend has been observed in consumer behavior regarding long-term care insurance in recent years? A. A significant decrease in policy sales due to lack of awareness. B. Increased interest in policies that offer a cash benefit option. C. A shift away from all types of insurance products. D. A decline in the aging population seeking insurance. Answer B. Increased interest in policies that offer a cash benefit option. Explanation. There has been a growing interest among consumers for long-term care insurance policies that provide cash benefits, allowing them more flexibility in how they use their benefits for care. This trend reflects a desire for more control over care options. Option A is incorrect. Awareness has generally increased, leading to more informed purchasing decisions. Option C is misleading. While some consumers may opt for other products, interest in insurance remains strong. Option D is false, as the aging population continues to grow, increasing demand for such insurance.